The ABC's business reporter Stephen Letts says the big question on interest rates is not when or even will the RBA cut, it's how much the banks will pass on. The will the RBA cut is a no-brainer, says the ABC's business reporter. I'm joined now by financial analyst Martin North. Martin North, good morning.
Hello there.
Do you agree with that assessment that it's a complete no-brainer? Is there anyone who's thinking the RBA board might not cut the official interest rate tomorrow?
Well, the official stats is 80% think that they will cut, the economists. So I think it's pretty much going to happen. But as you say, the real question is if it does happen, what will that mean in terms of the translation to low mortgage rates? Because we are reaching this horrible phrase called lower bounds. In other words, as interest rates get closer and closer to zero, it crushes banks' margins, makes it very hard for them to pass it on. And of course, every time rates are cut, we have to talk about the depositors who are losing ever more off their deposits. And there's 3 million households in Australia who rely on income from deposits. So every time the rates get cut, mortgages might get a little bit, but depositors have it taken away.
Well, there are certainly plenty in the business community and other influential figures who think that cheaper borrowing costs is not the answer to boosting economic growth. Do you think it'll have any impact on some of these storm clouds that we see on the horizon, or trying to protect ourselves, insulate ourselves from global shocks, which is what the Reserve Bank appears to be doing? Is it going to work?
Well, I think even the Reserve Bank is saying that they are getting close to the point where it's not going to have a huge impact, right? In fact, a recent speech by the governor suggested that there were other measures that the government would need to take to be able to think about improving the prospects here. The fact of the matter is that most businesses in Australia that I survey are saying, look, this is not a good time to borrow because we're not seeing consumers spending enough to make it worthwhile for us to invest in our businesses at the moment. And we know that many consumers are pretty much debted out and aren't actually able and willing to spend much either. So in a way, moving those interest rates down a little may give a slight impetus to the housing sector, although whether that's a good thing we can discuss. But more broadly, I think that ever low interest rates are probably now seen as running out of smoke.
So, I mean, the basic rationale is, to put it really crudely, is let's make it really cheap to borrow, hope that businesses invest loads of money, and then there'll be more jobs, more spending, etc. But it just it doesn't seem to be working that way, as you say. Do you think it's because people are in debt up to their eyeballs already?
Well, yes. I mean, household debt has never been higher. The statistics that came out recently from the RBA showed that. We are, and in fact, international statistics show we're first or second place, depending on the measures that you look at. So we have a huge amount of debt in the situation here in Australia amongst households at the moment, and many of them know that and are not able or willing. And whilst interest rates are being cut, of course, the banks are still tighter on their lending criteria than they were 2 or 3 years ago, even now. And the fact of the matter is that if you want to go buy a house and your job prospects are looking shaky and unemployment looking as though it could be rising, and with incomes under pressure, costs rising, you may not want to commit anyway. So to my mind, just looking at the interest rate lever is so myopic as to be almost impossible. I don't see how we're going to get any bang for our buck if we do cut rates.
So I know we don't have a lot of time, but what other methods does the Reserve Bank have at its disposal?
Well, I don't think the Reserve Bank has much else because the Reserve Bank is targeting inflation between 2 and 3% and interest rates. But the government has other strategies that it should be considering. In my mind, the government's actually hostage now to its own promise of maintaining a surplus, right, or achieving a surplus. I think it's time to understand that the economy is actually pretty shaky and we need some different thinking about how to stimulate the economy and what other levers may be pulled. I'm not sure that just clamping down on spending and relying on the resource sector to maintain the economy when the household sector is so weak, when interest rates are so low, actually makes a lot of sense. But
especially because they're asking us to spend and to not save our money and put it away. It seems like they're asking us to do one thing and they're doing something different.
Well, they are absolutely. And, households are raiding their savings. Households don't have the money to spend. And yet the government is saying, oh, no, our economy is absolutely fine. We've got huge employment, et cetera, et cetera. The truth is come down the layer. And, there are things that we've done internationally. Even people are saying, well, maybe we should be using these very low interest rates to borrow more, to be able to invest more in the future, and to be able to effectively help the economy along a bit. And I think that's a conversation we should be having here too.
Well, we'll see what happens tomorrow. Martin North, thanks very much for your insights.
Good to talk to you.
That's Martin North, local financial analyst there, talking about what most people, as you heard there, 80% of those surveyed think will happen, which is another cut to the official cash rate tomorrow when the Reserve Bank Board meets.